The Money Café is proudly brought to you by Intelligent Investor, Australia's home of value investing. For a limited time, you can get Alan Kohler's weekend brief, in-depth economic analysis, CEO interviews, the latest market insights, a limited edition Money Café cap and more for just $297. Find out more at moneycafe.com.au.
Hello, I'm Alan Kohler, Editor-at-Large of Intelligent Investor and finance presenter and columnist for the ABC.
And I'm James Thomson, Senior Chanticleer columnist at the Australian Financial Review.
And we are the Money Café. Good day, James. Welcome back from your holiday. And where'd you go?
I went to Japan, had a great time, 2 weeks with the family, did a few different things, went to the west of the country and did a bike ride, actually, for 2 days called the Shimanami Kaido, which is... a bike ride, about 70 Ks, so not too bad, but you go over 6 big bridges that link up 6 little islands in the inland sea of Japan. It was great fun. So first day at absolutely torrential rain, which tested the mettle of the touring party, but the second day, beautiful sunshine, and it was great fun. So, yeah, it was good to get out of the city.
I didn't know they've got an inland sea.
Yeah, it's beautiful. It's beautiful. And this bike ride, you can get... we had electric assisted bikes, which was a great way to do it, because these to get up to these bridges, there's some gnarly hills, and you just whoosh on up there. So even our 11-year-old was happy to jump on the bike and handled it all really well. So it was great fun.
And as soon as you get back, the Geelong oil refinery burst into flames.
Nothing to do with me, I assure the listeners. But, oh, man... timing's in business and in comedy, timing's everything, and wow, the timing here is awful, isn't it?
Oh, it's terrible. Are you writing about that today?
No, I'm not. I'm not officially back at work, but I'm joining the Money Café listeners. But I have been watching it this morning. It looks like just a really unfortunate accident at exactly the wrong time. It's going to reduce production at exactly the wrong time. I know you had some good graphics this week about the flotilla, the armada of tankers heading our way.
Yeah, but they're all carrying diesel. This is 6 boats coming from America with diesel. One of them landed in Newcastle, I think yesterday or the day before. There's 5 more that are coming over the next couple of weeks. And I'm pretty sure they've all got diesel on board. And the problem with the Geelong refinery is it makes petrol. And... I think it supplies 10% of the country's petrol. That's 10% not there anymore because the thing is offline. So, and nobody knows how long it's going to be offline for. Yeah,
well, I mean, from what Viva's saying today, it's going to be offline for some period, although there's some limited production still going on. But I gather aviation gas for smaller aircraft has been particularly hit. So, that's probably another issue for rural and regional communities. Alan, my sense of that armada, though, is that sort of what the government's been able to work pretty quickly to sort of pull together in the immediate response to the crisis. But I think what we sort of keep forgetting here is there's not a whole lot of oil still getting out through the Strait of Hormuz. I mean, we've sort of... Have we played the emergency card and now we start to settle down into the sort of grind of this oil crisis?
Yeah, well, so it's worth sort of bearing in mind that that the diesel price has gone up twice as much as the petrol price. So the diesel price yesterday was $3.18 or $3.20 a litre, and petrol's still in the low $2. So and the reason that diesel's gone up so much is that the refineries in Asia, in Singapore, Malaysia and Korea in particular, that we get the stuff from mainly, they need to get oil from the Persian Gulf because that's the grade of oil that you need to make diesel. The oil that they get from North Sea and America is good for petrol. Yeah. But the diesel is now in short supply because obviously no ships are getting out of the Persian Gulf. So there's a real shortage now developing of diesel. Now, I mean, as to how come all these ships have got diesel on them coming from America, I don't know. I mean, presumably that they're obviously making diesel in the US as well. But those Asian refineries that we get the diesel from are running out, and they're about to. I think in the next few days, maybe in a week, the oil that they have already got that's been delivered already and is in ships that are on the way there will run out. So they will very soon just completely run out unless the Strait of Hormuz opens up again. They'll run out of diesel. So what's going on is that Anthony Albanese is going around to these places, Brunei, Singapore, Malaysia and so on, and he's offering them secure gas in return for secure diesel. Yeah. And the thing to bear in mind, of course, is that Albanese and the government don't own the gas.
Yes.
So they can't promise it. All he can do, which is what he's doing, is promise that he won't stop it.
Yeah.
You know what I mean?
Yes.
Like he won't, if there's a crisis or
controls. Yeah.
Yeah. So he won't stop it, and that's kind of all that the Prime Minister of Singapore can do as well, because he doesn't own the fuel either. I mean, they're all private businesses.
It's been quite amazing this week, Alan, though. Like I've just been watching the stock exchange announcements, seen a series of, well, they're profit warnings. I mean, obviously from the airlines, that's not a big surprise. But even we saw Westpac sort of warn that this is probably the inflationary pressure here, the cost of living crunch is not going to be good for our loan book. We've seen a smattering of other industrial companies warn about, okay, we're now into the pain part of this, and yet markets just keep going. Particularly in America, does something feel disconnected to you, or is this just where we are?
No, it does feel disconnected to me. I mean, I was up late last night writing, sort of my views on this for the weekend briefing, and I think that to some extent the markets have decided that the war is basically over. It's just, but there's just got to be some shouting at each other across the negotiating table. But basically, it's over.
Yeah.
And the markets are kind of looking ahead towards it being all right. Now, I mean, obviously that's a big call.
Yeah. I mean, markets do always look, markets do always, in theory, look 12 months ahead. So I guess, you can think about that. The earnings outlook's still very good in the US particularly, but most of that's being driven by technology stocks that are largely unaffected by this. I mean, I think we're looking at, I saw some numbers last night. The profit growth in the sort of old economy is running at about 7 to 8% in the next 12 months. In the new economy, in inverted commas, it's running more like 30 to 40%. So, that new economy part of the market certainly powers everything along. So you can understand that. You can understand that perhaps stocks are a better bet than bonds at the moment because bond yields are going up, which pushes prices down. But, the average punter out there, whether they're in Australia or the US, they're about to hit this sort of stagflationary flat spot that's not going to be very nice. I just something doesn't quite feel right to me, or maybe this is just yet another example of financial markets are not the real economy. They are a sort of bubble on their own, and the bubble wants to inflate.
I think the other thing is that there's a binary kind of thing going on here. My friend Gerard Minack put out a note this week in which he said that the reason, part of the reason, if not the main reason, that markets are still up, and in fact the S&P 500 and the NASDAQ have both regained their previous peaks, is because of earnings upgrades, mainly with energy stocks, which obviously is because of the increase in the price of oil and gas. So they're making a lot more money, and also technology. So the technology stocks are being upgraded, their earnings are being upgraded as well. And all of that's fine as long as there's not a recession. So then I looked at what's the odds of a recession, and the answer is around about 30%, 35% chances of a global recession, which is not like obviously not zero, but it's not 50%. It's not like more likely than not. And so I think the markets are basically saying there's not going to be a recession. Earnings are going fine for tech and energy stocks, so we're okay. I think some of the and the other thing that's going on is the Wall Street banks are making an absolute mozza because of the volatility. I mean, Goldman Sachs and JP Morgan and these banks, they're reporting huge quarterly profits now from equities trading and commodity trading because they all make so much money when there's volatility, which there is.
Yeah.
So, the other thing I think that's going on with the markets is that I think, and I've been reading a few investment strategists on this subject, there's a big difference between the behaviour of Donald Trump and what's going on underneath in the White House. So there's a bunch of characters in the White House who are, I don't know what you'd call them, they're serious people. The main one being a fellow called Elbridge Colby, who is the Undersecretary of War for Defence Policy. And he's the guy who wrote the National Security Strategy, the America's National Security Strategy, which was published last November.
Yes.
And it laid out the whole kind of contest with China and that it's all about China. And so I've been reading some strategists who kind of say, well, what's going on both in Venezuela and now Iran is the implementation of that strategy. And the serious people in the White House are basically doing that, led by Elbridge Colby, and they're kind of putting this plan that was laid out in the strategy document in November, putting this plan into practice, and they're doing it methodically. And meanwhile, Trump is posting on Truth Social at the rate of, 50 to 60 posts a day, right?
Yeah.
And he's gone mad. With posting about the Pope and putting up things about Giorgia Meloni, the PM of Italy, and also pictures of himself looking like Jesus and all this. I mean, so what's happening is the media are focusing, and politicians, they're all focusing on Trump, right, which is understandable. And he's gone crazy and he's all over the place and everyone's going, this is mad, this is chaotic, everything's chaotic in the US, nobody knows what's going on, the US has no strategy. And this is because, if you look at Trump, that's what it looks like. But in fact, there is a strategy and it's quite, it's quite serious and it's being methodically implemented. So there's a bit of that going on with the markets as well.
Yeah. I struggle with that sort of overarching grand strategy thing. I mean, because the basic idea is that America needs to be more self-sufficient, that the sort of Trump's gone a long way away from America first, but that White House clique, their view is that America needs to be able to defend itself more stridently than in the past, and it needs to have better energy security and better manufacturing capacity. Those are key to security of the country, sort of military security and key to economic security. I get that idea, certainly, but I just wonder if people sort of start to what I've seen with the twists and turns in Iran is it's a bit of a choose your own adventure. Whatever you think about the world and Trump, you can make the facts fit what's happened. We've seen capitulations and deals and ceasefires and then, new waves of aggression. Now this blockade of the Strait of Hormuz, which was never closed before, and Trump wanted it opened. He's now closed it himself. I mean, does this really speak to grand strategy? I'm not sure. Well, I think the thing it speaks to me is everybody's going to be spending a lot more on defence. Everybody's going to be spending a lot more on their own energy security over the next 2 decades. That's, that might be good for markets because, fiscal stimulus is generally good for markets, but it's also going to put pressure on inflation and keep interest rates up. And that might tell on markets at some stage because that's happening in a world that is awash with debt. So I can see the grand strategy, but I don't think the grand strategy is an automatic winner for markets.
No, I agree.
Let's remember what markets are pricing here. They're pricing no recession, no interest rate hikes, no stagflation, nothing bad happening for the next 5 years. I mean, how likely do you feel that is at the moment? I don't know.
It's already incorrect.
It's already incorrect. That's right. So, it's a fascinating time, isn't it?
Before we get on to questions, Gina Rinehart's loss in the court.
Yeah.
So is she going to have to put the hat around now? Is she going to go broke or what?
I'm not sure it was a loss, Alan.
Right, okay.
A loss. I think certainly she's going to have to. There's going to be some payment made from the Rinehart side to the Wright side. So this is Peter Wright, who was Lang Hancock's school friend and business partner. The Wright family sued the Rinehart/Hancock family, demanding royalties for iron ore sales that have been made over the last few decades and a big equity stake in some of the iron ore mines that the Rineharts control. So the Wright family, they won on the royalties part, but they lost on the equity stake part, and that's where that's the one that would have been really expensive for Gina. So she's counting this as a win, and I'm sort of inclined to agree with that to a certain extent. She's still going to have to pay hundreds of millions in royalty, it appears. But, I think this is all about control and control over long periods of time. I think Gina Rinehart's control over these very valuable iron ore tenements is maintained. So I think she's probably the winner. After years of legal wrangling, which I guess means the real winners, of course, are the lawyers, as always.
Oh yeah, absolutely, that's right.
But yeah, it's fascinating. It's these sort of these feuds go for decades over iron. This feud particularly has gone for decades, and that's because of the huge amounts of value at stake. We forget how much iron ore revenue has been created and how much wealth's been created, how much tax and royalties have been paid. Yeah, it's still a very important, hugely important business and really valuable. So, yeah, it's what a fight.
Now, before we get to this week's questions, here's a quick word from our sponsor.
If you're listening to the Money Café, you're probably the kind of person who doesn't want to be caught out by the next big shift. Whether it's AI, a policy change that hits your hip pocket, or a market move that catches most people off guard. Right now, Money Café listeners can get a special deal on Intelligent Investor Essentials. For just $297, you'll get Alan Kohler's Weekend Brief, the latest market and economic updates, and subscriber-only podcasts, including CEO interviews and Talking Finance, with in-depth interviews on business, the economy, and investing. And when you sign up, you'll also get a limited edition Money Café cap plus 3 months of Intelligent Investor Premium. That's $726 of value for just $297. Go to moneycafe.com.au to claim it before it ends. T's and C's apply.
Also, before the questions, remember this is general advice only, not personal advice, because we can't do that. So just bear that in mind. And first questions from Rosemary. I'd love to hear your thoughts on the economics of the NDIS. We keep hearing the NDIS is too expensive, but if it's supporting people to work and participate in the community while also creating jobs, shouldn't we be looking at the return on investment? If it's contributing to higher workforce participation and generating more taxable income, is there a risk that cutting it could actually make the economy worse? Well, you go first. What do you think, James?
I think Rosemary makes a good point that you do need to think about the economics of the NDIS holistically. And I guess the challenge with healthcare jobs more specifically is that they don't tend to grow the economic pie, they tend to maintain the economic pie. So while healthcare workers work harder than almost any group of people in society, the productivity of those jobs as measured by sort of output isn't seen as high as some other sectors. So, yes, I think Rosemary makes a good point that we probably need government spending through healthcare and particularly the NDIS has been pretty important to keeping Australia's economy ticking over, along with population growth in the past few years. So yeah, we probably do want to be careful about how quickly you pull that spending down. But I guess, Rosemary, we're just trying to spend on so many things at the moment. You know, healthcare, NDIS, aged care, defence, education. We just can't have everything. So we need to be able to make these programs work super efficiently, as efficiently as they can, and get the best bang for our buck out of these programs. I mean, that's what the goal here, I think, Alan, with the NDIS.
Yep.
We just want to help as many people as possible, and for that to happen, you want the program to work super efficiently. I think there's no doubt that it's not working efficiently and effectively at the moment.
When I interviewed Jim Chalmers a couple of weeks ago for the ABC, I put to him that the fact that the NDIS is costing far more than expected, doesn't that by definition mean that it was poorly designed, or at least it was designed in such a way that it's doing things that they didn't expect. It's costing more than they expected. So therefore, they need to adjust the design back to what it ought to be, or at least, I mean, so anyway, he didn't answer that, of course, but I think it seems to me that by definition it's problematic. It needs to be thought about. I mean, if it's, and the thing is, Rosemary's right that it's providing two benefits. One is that it's obviously supporting and helping disabled people, but also it's providing an economic benefit by, you know, injecting money into the economy through jobs and so on, income for businesses that are NDIS focused businesses. But you know, the on the other side of that, it's weighing on the budget, and you know, and also it's tending to operate against what the Reserve Bank is trying to achieve at the moment, which is to slow things down. So the NDIS is itself an economic stimulus at the wrong time.
Yeah. It's not, as I think we keep saying, a great program that you want to. We want the nation wants the NDIS to work as well as it can. We want it to be as waste free as possible. So the spending that we do allocate to it gets the biggest bang for its buck. I mean, helps the most people possible in the best possible ways. I think that's the crux of it. And it just feels like there's too much waste. It's not working effectively. You know, you hear some crazy stories about the rorting and overcharging. We don't. That doesn't help the people who need that money the most. Anyway, it's I think it's something that's to your point on the design, Alan. This is not something that's been tried. It's a new concept. I don't think we should be afraid, or I don't know if afraid's the right word, or unwilling to keep tweaking it till it looks right. And that may take 30 years. There's lots of programs.
Yeah, that's right.
They need big national programs that need constant tweaking.
No, I agree. That's what they need to do. They need to tweak it.
Yeah. David says, I'm sure you're familiar with David Pocock and his work to establish a Senate inquiry into gas exports. What are the practical and political elements preventing this policy from taking hold? Seems a win-win for Australia at a policy level, the only losers being those with direct or vested interests.
So I'm presuming David's surname is not Pocock?
Yes. Mere coincidence.
Well, the main practical and political thing preventing this policy from taking hold is that the gas companies will complain.
Yeah.
There'll be a sovereign risk element, which, you know, everyone. What would be happening is that the gas companies would be sitting in front of the Prime Minister and anyone else in Canberra that they can get hold of, and say, "Listen, if you do this, there'll be a big decline in investment in Australia, and do you really want that?" And so on. So look,
yeah, if you change the rules on us,
if you change the rules, you know, everyone's going to pull out, and you know, it'll be terrible and all this. And the problem with a lot of this kind of policy stuff is that the people who are against it like in the gas companies, they get to, there's only a few of them, they've got a lot of money and they're powerful, so they get a meeting with the Prime Minister or whoever, and they're able to employ lobbyists. The people who benefit from such a thing is everybody else in the country. So, and we, the other taxpayers, don't really have the ability to employ lobbyists. You know what I mean? Like, so there's a asymmetry in loudness of voice, it seems to me.
Yeah.
Would you agree with that?
Just yes, of course there is. But just generally, it's probably not a bad time for us to have a holistic review of energy policy in this country and taxation settings. I mean, the issues of energy security, we've got a few questions on this in our lot here. This is coming back to our point about the US strategic view of the world. This is only going to become more important over the next couple of decades. And so how we think about energy in the country of all types is probably worth a bigger picture, review. And that would include tax settings. I mean, it would also being an energy, given we don't have, as we're seeing at the moment, given we don't have a whole lot of oil production and oil refining capacity, our status as an energy exporter has actually been pretty helpful in the last, 6 weeks. So some of those considerations might come into play too. Maybe it is time for a bit of a holistic look at this.
Yeah. Well, we had one with the Ken Henry review of taxation policy, and he recommended some extra resources taxes, which the Rudd government tried to do and, famously failed.
Yep. No, and that is the problem with big picture reviews in this country. We never seem to like the answers all that much.
Ben says, I'm a big fan of the show and the Kohler dynasty. More broadly, I'd like to hear how you guys manage the emotional side of investing, in particular selling dud performance and crystallising your losses. For context, I've been talking to Gemini about some portfolio advice for my shares. After much back and forth, he'd recommended selling my crumbling stake in FBR, which stands for Fast Brick Robotics, and paying down my margin loan. Now listen, Ben, we can't give personal advice, so we're not going to, Gemini might be able to, but we're not going to tell you what to do with your shares. However, I mean, I don't think one should have margin loans to buy speculative stocks. I don't think that's a very good idea. So the thing that stands out to me with your holding in FBR is the margin loan. I mean, I don't know whether this stock's going to do any good or not in the long term. I think the idea of having a robot lay bricks is interesting, but it's long term. I mean, where this company's going is that the technology that they developed to have a long arm. So what they've got is that, and their real sort of the core of their technology is the ability to have a really long arm that will hold fairly heavy stuff, i.e. bricks, and be stable. And so what they're now doing is selling that technology to other possible uses apart from laying bricks, such as unloading ships and so on. I think they might have even sold one of these machines to the port in Darwin. So that might work out. I mean, I don't know, but that's the decision you have to make. But I reckon if you've got a margin loan, I mean, you can invest in something like FBR for the long term, and maybe they'll come good, maybe they won't. Who knows? As long as you haven't got a loan against it. I mean, crikey.
Well, I'm just going to step back from this a bit. So Ben's asked us about advice on managing the emotional side of investing, right? He's gone to Gemini to ask for that advice. AI built on nothing more than the data it's ingested. He doesn't like the answer that Gemini's given him because it's too cold and practical. And he wants us to tell him that everything's okay, I think.
Yeah, right.
And he should just continue doing what he wants to do, which is his view is that the opportunity cost of holding this stake, being the interest on the margin loan, is so much less than the potential to get your money back. So, Ben, I think your answer is in the question itself.
Yeah, I totally agree.
You can't take it. You can't get it of advice. I'm not. I've got huge question marks over taking advice from Gemini about this, but I would suggest that you've been given some advice and you don't like it. You do have to think rationally about these things, and if to your point, Alan, if you just bought these stocks outright without the margin loan, maybe you could cop the holding cost of the opportunity cost of holding onto them, because it would be a lot less than it is now for you, Ben, with the margin loan sitting there. So I don't know. You've encapsulated your problem very nicely.
He's paying 9.65% for the
exactly
for the margin loan. Crikey.
Yeah.
Anyway.
Stuart says, why are we still quoting the price of Brent and West Texas intermediate oil on the news every night when the majority of our diesel, which powers the entire Australian economy, comes out of Southeast Asia, whose oil in turn is sourced predominantly from the Persian Gulf? Why aren't we quoting the Singapore Gasol 10 p.m. benchmark?
Well, because they're hard, because those numbers are hard to get. Those are owned. Those numbers are owned by somebody, and they don't let you know. Whereas you get Brent and West Texas on Bloomberg or wherever. I mean, they're just
places,
widely available. So and they're the main benchmarks, and so that's what we quote. I mean, I would quote Singapore gas oil if I could. Gas oil, by the way, is diesel. I would quote that if I could find it, but I can't.
Yeah, but I think, Stuart, there's still value in quoting something in Brent and West Texas, because those benchmarks are well established. There's a lot of history to them, so we can follow the ups and downs of them, and ultimately they do feed through, as Stuart's pointed out, they do feed through to the Singaporean refined prices anyway. And yes, sure, that the Singaporean prices are moving a lot more, but I don't think that point's been made repeatedly and frequently as well. So I think there's value in historic benchmarks, because it tells the story. It helps explain things over a long period of time. It puts things in the historical context as well as the current context. So I reckon that's really important.
Deborah says, I read your interview with Paul Schroeder about the Australian dream. I was shocked by his grave concern about housing. I have attached a link that tells me there are 3,200 empty dwellings in the Clarence Valley, plus 800 Airbnbs. I don't believe we have a supply issue. It is the usage and investment issue controlled by government policies that is denying our young kids access to the Australian area. This feels more like misinformation war to influence hate against immigrants who are being blamed for the housing supply shortage. The Australian Institute has been recently coming out saying that there is no supply shortage either. Do you know where the Clarence Valley is?
No, I don't.
Hang on, I'm just I'm just Google Mapsing to see if I can find out where it is, because I presume all these houses are holiday houses. Clarence Valley, New South Wales. Yeah, it's in the kind of hinterland of the mid-north, mid-central coast, I think.
Yep.
Yeah, so these are presumably holiday houses or something. Look, I mean, yeah, sure. There's a lot of holiday houses that are empty most of the time, and the people go there on the weekends or something. I don't know. But what's the government going to do? Pass a law that's saying, you have to let people live in your holiday house? So, I mean, I think a lot of this stuff is a bit spurious about, these empty houses.
Yeah, Victoria has tried that, we should say, holiday houses, increasing land taxes on second residents and things like that.
Yeah.
So hasn't made a huge difference to prices or supply.
Yeah, and a whole lot of people who own a holiday house have sold them or tried to sell them and can't because there's too many on the market.
Yeah.
So, yeah, I mean, and so is there a supply issue? Look, I think I've been reading the Australia Institute stuff about saying that there's no supply shortage, and I think, okay. I think that the fact that house prices have been, for 25 years, rising at twice the rate of inflation, CPI inflation, more than twice the rate of wages, tells you that there's a supply-demand problem. I mean, there is clearly a shortage of housing. So whether you attack that by increasing supply or by reducing demand kind of doesn't matter. It seems to me. I mean, you know, immigration clearly is higher than it used to be. I mean, it's coming down now, but it has been very high. You know.
Yeah.
Now, to state that as a fact, is that blaming immigrants for housing affordability? No, of course not. It's just simply a matter of numbers.
Maths.
You know, and if the governments can come up with enough housing to meet the demand, fine, that'll be great. But I actually don't think they can, and I don't think anyone's going to pass a law that says all empty houses have to be made available for people who want to live there. You know, I don't think that's ever going to happen. So, you know, we can fulminate about holiday houses and empty houses and Airbnbs all we like, but nothing's going to be done about it.
All right, another property question from Dylan. He says, regarding grandfathering of the CGT discount, why doesn't grandfathering just create more intergenerational inequality? Existing investors will always have an advantage over new and young investors. Further, couldn't this create a lock-in effect where nobody sells their grandfathered assets, further drying up housing supply? Shouldn't housing carry risk, like the risk of tax reform, like any other investment? I understand politically that grandfathering will be unpopular for investors, but surely that is not enough to further put back young Australians.
Well, Dylan's absolutely right, but you know, what are you going to do? I mean,
I'm not sure Dylan's absolutely right. Yes, housing should carry risk like other forms of investment, but when we've had suggestions of changes to taxation of other forms of investment, there either has been grandfathering or there's been deep protests against that. You know, you buy an asset under one set of rules. Are you entitled to think that those rules should continue? Probably.
Yeah, I think so.
Grandfathering. Now, I think the issue we've got is that because the scale of property investment in the country is so big, the grandfathering is going to capture a lot of people. But will it lock those properties in? I'm not sure. I mean, if you ask someone like Evan Thornley, who used to be a tech entrepreneur, then a politician, and now has a property business, he reckons most people, you know, get their property investments wrong and don't make any money out of them, or make very little money out of them anyway. So whether it locks up property investment, I'm not sure. Yeah, tough one. I think we need to make a start, Dylan, on the change. So reducing the CG discount. It's not maybe it's not perfect, but it's not nothing, and we need to start somewhere with this.
What I was saying about him being right, I think he's right that it will worsen inequality to some extent. But you know, again, I think it's really difficult for the government
worsen
not to
inequality.
Well, you know, people who
will make it'll be worse than it would be now.
Well, it just means people who have got grandfathered properties, you know, because they've owned them a while, will make more out of them eventually than those who buy now. Who are by definition younger, I guess. I mean, that's kind of the problem.
Just while we're on this topic of inequality, Alan, I'm going to flick to one of the questions right down the bottom, mainly because I actually did some numbers on it. And the question is from Philip, who says he finds it hard to understand the concept of intergenerational inequality. And I think this is a good point a lot of people make. Alan, he says he bought his first home in 1974 with a 30% deposit he'd saved on a single income, no childcare subsidies, no second salaries, interest rates that would make today's borrowers faint. And he didn't eat out, didn't travel, and drove the same car for 11 years. No one called that a structural injustice. We just called it getting on with things. So when economists and politicians talk about intergenerational equality, I'd like someone to define it with precision. Are we describing a general structural failure in housing supply and wage growth, or are we dressing up a preference for consumption now as a policy emergency? I just used Philip's numbers there. So in 1974, the average annual salary, or median salary, was $7,600. But the average median house was about $25,000. So 3.3 times the average median salary. Today, the average median salary is $74,000. The average median house nationally is $1.17 million, which is 15.8 times the median salary. So, Alan, I'm sure there's a more technical definition of intergenerational equality, but to me that sort of sums it up to some extent. In Philip's generation, a house was worth 3.3 times the average person's annual wage. Today, it's 15.8 times. So Philip's generation, buying a house was possible. In the current generation, for the average annual salary holder, it's very, very, very difficult. I mean, one generation could do it, the other can't.
I think you put your finger right on the problem. I mean, and I think that's really that is in almost the beginning and end of the whole problem, which is the change in the relationship between house prices and incomes, which has completely changed. It's increased 4 or 5 times, and so that means that a house that now costs $1 million should really be costing $300,000.
Yeah,
I mean. And think about that. I'd say that to people, somebody, if you look at somebody, they've just paid $1 million for a house or $1.5 million and they've got $1 million mortgage and they're really struggling, that house should really have cost them $300,000 or something. I mean, that changes everything. I think that thing that you just talked about has changed everything about Australia.
Yeah. I think it's really important to say that, no one's taking a shot at Philip's generation. They played the cards they dealt with. They made lots of sacrifices, as Philip explains. But now, even if you make all those sacrifices, it's just not possible. The numbers don't add up. The maths doesn't work. You couldn't drive the same car for 11 years and then at the end of that 11th year, miraculously, you'd have enough money for a house.
Yeah.
It just, no one's saying that Philip's generation did anything wrong, but back then it was just entirely different. And you can throw lots of other things in. People in Philip's generation have enjoyed, a long, long period of falling rates and rising asset prices in all parts of the economy. Look at what the share market's done. Superannuation, obviously that involves sacrifice as well, has been a huge beneficiary to wealth. But I think it just boils down to that idea. One generation, buying a house was possible on a single income. Now it is completely impossible. That's it.
We've got time for one more question. This one's from OG listener, Ali. As an Australian-born Iranian, I have a bad feeling that the effects of this war on Australia are permanent and likely to get worse. I'm too young to know how the last oil shock affected the country. Do you have any practical advice on how to prepare for the economy we're living in now and what this new normal will actually look like? Yes, well, the last oil shock was at the time of the Iranian Revolution in 1979, and that it's interesting because what I think happened then, and I was around at the time, is that OPEC used the cover of the Iranian Revolution to double prices, and I think prices increased from $20 to $40 a barrel or something. And the Iranian Revolution didn't actually cause a decline in output. I mean, the Ayatollah kept Iranian production and exports going. So there wasn't actually a change. The only time there was a change was before the Ayatollah took over in December 1978. There was a general strike in Iran of people protesting against the Shah, and that resulted in a big drop in output from Iran. But by the time the Shah left in January of 79, Iranian production was back to normal. So actually what happened in 79 was not the sort of thing we're seeing now. And that's why the International Energy Agency is saying that this is the worst oil shock in history, because the the shutdown of production caused by the blockade of the Strait of Hormuz is 20% of the world's supply, which is more than was shut down back in the 70s, whether it was 73 or 79. Anyway, so practical advice on how to prepare for the economy. What do you think, James? Have you got any?
Oh, I don't. I have been thinking about this question, and I think so far we haven't really. No, there hasn't been a whole lot of behavioural change at all, and I think, you know, when we left two weeks ago to go on holidays, fuel prices were a lot higher than they are now, of course, because the fuel excise has been cut. So we've really been allowed to, you know, make basically no changes. But we are likely to see in the back half of this year a period of stagflation where growth is pretty crappy and inflation's pretty high. So, you know, that's a pretty fragile economic state. Alan referred earlier to the chances of recession, 30%. That's not nothing. That's a 1 in 3 chance of recession. So if a recession hits and we see a spike in unemployment, my fear would be that we just haven't recession in decades, Alan.
No, that's right.
Australia's uniquely unprepared for anything like that. So I don't have any practical solutions, but it's just an interesting thing to think about.
I spoke to Lucy Ellis yesterday, who's the chief economist at Westpac, used to be the head economist at the Reserve Bank, and she's predicting 3 more rate hikes this year. 3 more rate hikes. We've already had 2. That would make 5 hikes in the course of 12 months. And she's an outlier. She's the only one predicting 3. I think there's quite a few predicting 2. I mean, if she's right, and I wouldn't bet against her, to be honest, but anyway, if she's right and there's 3 more rate hikes, then I think there's a fair chance of a recession in Australia.
Yeah.
I mean, basically she seems to be saying that in order to control inflation, particularly since the war has been going on, the Reserve Bank will have to cause a recession to happen in Australia.
And then, Alan, just to throw in another little wild card, if we had a recession, you know, they're not good for employment, but could you see that speed up the adoption of AI as companies try and cut costs and protect profit margins? You know, I think that's the other thing. We sort of forgotten a little bit about AI over the last 6 weeks, but its march continues. It's an interesting little moment.
It more than continues. I mean, the development of AI remains exponential. I mean, they're just getting better and better all the time. It's incredible.
Yeah.
I mean, I looked at a website the other day that is a AI agent shop,
right?
And they've got hundreds, like 1,000 agents that you can just buy off the shelf that do stuff for your business.
There wasn't a podcast co-host agent, was there?
Well, there will be if there isn't now. Certainly. Yeah. I mean, there's you know, basically everything that you've got human beings in your business doing, you can buy an agent for that will do it instead.
Yeah.
So,
yeah. Fascinating.
Okay, thanks everyone for listening to today's episode of the Money Café. I'll be back next week with Stephen Mayne. Send in your question and we'll try to get to it. We've got a lot more questions today than we were able to answer. Sorry about that, but you know, we're not one of these 3-hour podcasts, not yet anyway. Anyway, email us at themoneycafe@intelligentinvestor.com.au. Till then, I'm Alan Kohler, Editor-at-Large of Intelligent Investor and Finance, presenter and columnist for the ABC.
And I'm James Thomson, Senior Chanticleer columnist at the Financial Review. Talk to you soon.
Thanks for listening to The Money Café. If you want a little extra to take away with your latte, try Intelligent Investor Essentials. Go to moneycafe.com.au. For just $297, you'll get my weekend briefing at 7 a.m. on Saturday morning, Talking Finance podcast, CEO interviews, plus a Money Café cap, splendid thing it is, and 3 months of premium. That's Intelligent Investor Premium. It's a great deal. It's valued at $727 for just $297. Get in quick at moneycafe.com.au and T's and C's apply.